Resideo is breaking up. CEO Jay Geldmacher has been running Resideo since May 2020. The stock is up roughly 266% since he started. Meanwhile, the S&P 500 is just up about 135% over the same period. This time, it isn't an underperforming stock story. Since the CEO started, the operating income has nearly doubled, but the debt is nearly 3 times as high. Now he's cutting the company in two and leaving. In this video, we find out if there's still value left inside Resideo or if investors should walk away too. When I went over the balance sheet, I noticed the huge debt this company has. Back in 2020, they owned $1.3 billion and currently their debt is $3.2 billion. And the reason why the debt is so high, they borrowed money to buy a company, Snap One. And last September 2025, they made also a deal with Honeywell to end an old obligation from their 2018 spin-off. They had a deal with Honeywell to pay up to $140 million per year all the way to 2043. So they paid a $1.59 billion in one lump sum to end this obligation. And this is really shocking. A huge part of the debt doesn't even have a fixed interest rate. In 2020, Resideo had $780 million of this kind of debt. And currently, it nearly tripled to $2.3 billion. What it means that for every quarter of a percentage change in interest rate, that's about $5.8 million change in interest payment. On top of that, the yearly payments of the debt has gotten also more expensive each year. In 2020, interest payments cost $139 million. For 2026, they expect this will be $180 to $185 million, while operating income is around $748 million. It almost 25% of their operating income goes straight to interest payments. When we look at the margins, you can see that the gross margin, the profit left after making the product, was 29.5% in 2018. In 2025, it's 29.4%. Basically flat after 7 years of growth. Also, the operating margin tells an even clearer story. In 2018, it was 10.2%. Today, it's about 8.7%, actually lower despite higher sales. Normally, growth should improve margins. Bigger scale usually means more efficiency. Here, it's the opposite. And we have the tariffs problem. That also didn't help. Resideo makes a lot of its products in China and Mexico. And apparently they cannot easily pass it to the customer. So was Jay Geldmacher a real bad CEO? I don't really think so. He also came in a crazy time because Resideo was just spun off from Honeywell and we had the economic downturn of 2020. So he didn't improve the margins despite the years of growth in sales. Right after the spin-off, next week he will leave his role as CEO and move into a senior advisor role. Now let's figure out what each piece is actually worth. Quick disclaimer. First, I'm not a financial advisor. My own opinion, not investment advice. Do always your own research. And remember, you always can lose all your money with investing. Now let's look first at the enterprise value of both companies. I took a low and a middle case. We start with Resideo's product and solutions business. On the low side, we get $7.32 billion and our base case is $9.18 billion. Adding ADI global distribution gives us another $2.74 billion in the low case and $3.75 billion base case. Combined, that gives the entire company an enterprise value between $10 billion and $12.9 billion. Next, we subtract all the liabilities. So we have first $2.8 billion in netto debt. After the spin-off, $2 billion will stay at Resideo. Second, we have $500 million for the preferred stock obligation. And third, $93 million for the netto pension liability. After deducting those obligations, we get a combined common equity value of $6.6 billion to $9.4 billion. Dividing this by the shares outstanding, we get a $44 to $63. Today's stock price is $36, so that gives up an upside of 23 to 75%. When we take the expected EBIT of this year, which will be 660 to 720 million, we get an EBIT yield of roughly 8 to 9%. When we use the Greenblade method, we get roughly 44% return on invested capital. Resideo's main product business keeps getting better. Profit margins grew from 36% in 2023 to 39% in 2025. Earnings margins went up from 16% to 20%. ADI tells a different story, as you can see. Its earning margin stays low, near 6%. You can see clearly that Resideo is getting better and better, while ADI stays a weak business. This is, of course, the hidden value. Both also will get another EBITDA multiple, and that's where the huge upside can come from. After the split, Resideo will work on its own as a maker of smart building tech and home controls. They build home hardware themselves. They own the #1 fire safety brand, First Alert, and they have the only rights to use the Honeywell home name for thermostats and security systems. They don't just sell hardware. They also earn steady money from spare parts, repair service, and cloud software that runs connected devices. The company expects to grow sales by 4 to 5% each year. Gross margins should rise to 40 to 45%, and their EBITDA margin should climb to 23% to 25% from the 20% now, as you can see. They also plan to pay off debt fast, cutting their debt level from 3.3 times EBITDA down to 2 times EBITDA within 24 months. And when we look at the risks, Resideo is the #1 seller of normal thermostats. They are already more than 100 years in this business. But big tech companies lead with their products like Google Nest and Ecobee. They are the #1 in smart Wi-Fi. And keep in mind that these smart home devices aren't even the core business of these huge big tech companies like Google or Amazon. After the split, ADI will work on its own as a public company that sells goods in bulk. They don't make products. They act as a #1 warehouse middleman for security, gear, fire detectors, and audio and equipment. They buy cameras and access control tools in large amounts at a discount from big manufacturers. ADI expect to grow the sales by 4 to 6% each year. Their EBITDA should grow from 295 million to 500 million, and their margin should rise from 6% to 8%. Like Resideo, ADI also plans to cut its debt down to 2 times EBITDA from 3 times currently. The big question is, of course, whether ADI can really do this. As a distributor, ADI has no real special price advantage. And we have also seen that even when the sales grows, that didn't lead to lower costs. So looking ahead, growing profit margins without a clear advantage will be challenging. The 2 CEOs who will be running are Thomas Surin, the incoming Resideo CEO gets 900,000 base salary and a bonus target of 135% of that salary. Robert Ernest taking over new standalone ADI gets same, also 900,000 base salary with a slightly lower bonus target of 125%. Both CEOs owns a lot of stocks, hundreds of thousands shares each, but it's almost entirely from the company pay, not money out of their own pocket. Neither has been buying more on the open market, and the new CEO of ADI has actually selling shares. Wallstreet is optimistic about this breakup. They have a price target ranging from about $35 to $55. This is my take. Compared to competitors, we can clearly see there's value hidden inside the company. And it will be probably released after the spin-off. What bothers me the most of this investment ID is the heavy debt. Not only that their interest payments is a huge cut of the operating income. And also it bears the risk that the interest rates can go up easily because it has a variable interest rate. In this situation, time is totally not on our side. Currently, I have no intention to invest in this company. I'm already invested in a company with a huge debt called Comcast. I made a video on that one too. I don't want to add another one. But if I needed an investment ID, here's how I would play it. I would buy a small position and I would only buy for the breakup value, not for long-term holding. Once it hits my calculated intrinsic value, I would sell immediately, unless there's a real buyout talk by then. Otherwise, I would sell it, sit on my money, waiting for a new ID. If this video was helpful, just let me know in the comments.